afternoon, everybody. I'm Phillip Nelson, head of asset allocation at NEPC. Joining me today is Tim McCusker, our chief investment officer. Just to timestamp things, today is November 9th. It's the day after the election. Waited to the afternoon just so we could see a little more results roll in. But I think the way things are trending, it's probably going to be much longer than most folks are going to hope for until we have some final answers on this front. But wanted to kind of just briefly chat with you, Tim, on a couple points. One is talk a little bit of the election, some of the investment implications maybe we're going to see. Also, bounce around a little bit, talk a little bit of inflation, and then also a little bit on what are we seeing in terms of some of the different investment regimes that we could be seeing. Are we in a transition? Are we in a new regime? And cover some of those items. Maybe the first thing is just talking about an election night. So as I mentioned, it's the day after the midterm elections. We still have a lot of races that haven't been called yet, undecided. I think the trend is we probably have a small Republican majority for the House. The Senate is trending towards a Georgia runoff in December being the deciding factor of who controls the House. That said, we're looking at a divided government regardless, with President Biden being in office. And historically, that's been fairly positive to markets, a divided government. But Tim, want to get your thoughts on the election and any kind of early implications you think this has for our investment outlook.
Sure. Thanks, Phil. Great to be on here and chat about this. I think this is something where if we were political strategists, we'd be talking about how surprising the outcome is and what a shock it is how relatively well Democrats did relative to expectations for midterm elections. And there was, even over the summer, there was some excitement for Democrats, but it built back up that we were going to see more of a red wave. That didn't materialize or anything close to it, but Republicans did do enough to more than likely win the House. And then we'll see on the Senate, which, not to trivialize the Senate, they do a lot of important stuff, but the split government is split once one side of things is in the other direction of the president. So in a lot of ways, it doesn't matter too much, and we've got a split government either way. As you pointed out, that's typically good for markets. There's a certain amount of certainty knowing that there will be gridlock and that you won't have major surprises in policy. It does set up some really interesting things for 2024. I think the outperformance of Democrats probably empowers Biden to consider running again, and then down to the state level, some governor performances certainly lead folks like Ron DeSantis to feel really empowered to go after the Republican side of things. So we could be, depending on how things play out, there's a lot of stuff that has to happen over the next 2 years, but you could trend towards a Republican sweep after all that's said and done in 2024. But that's getting way far out there and out over my skis for what I know about. But I think for the near term, we're looking at not a lot of major activity in Washington, D.C., a lot of gridlock, tough to govern, and that's probably generally good for markets.
Yeah, and as you mentioned, thankfully we are not political strategists. I think we enjoy the investment side for a reason. But it's interesting, this is probably day one of the presidential election cycle now. It's probably, a lot of folks are already thinking about, who's likely to be running. And, to your comment about the divided government that we're going to see, the kind of new presidential election won't be, or the new president won't be in office until January 2025. So essentially, we have 2+ years of gridlock kind of locked in now. And that's generally been a favorable environment for risk assets, equities, and credit included. But I do think the piece that is kind of hanging out there, and at times we've had to chat about this over the last decade or so, various points, is just thinking about the debt ceiling. Whether that's something that gets cleared up in the lame duck session over the next 2 months, or is this overhanging, Congress and the markets, which is probably the more concerning piece, January and February, because obviously we've had a lot of volatility flowing through in treasury markets. I'm not sure we need any more at this point. That's something that's definitely out there.
Yeah, the debt ceiling is a big issue that will come up a couple times over the next couple years. It's a more acute issue now with rising debt service costs. So there's going to be more scrutiny there than there's been before. I think the other thing that happens because of this, we've talked ourselves a lot about a regime change. We talked about it at our client conference this year, and it's something we'll talk more about when we wrap this up. But you think about most of this quantitative easing regime, we've forgotten it because of the last couple of years, because you had so much fiscal stimulation due to COVID. But most of that 12-year period was characterized by gridlock. And one of the big implications of that was that it meant the Fed and other central banks around the world, where gridlock was happening for different reasons, had to do most of the work.
Yeah.
And so I think what we come back to here is that the onus is on central banks once again to move things forward in a very different way, in a tighter way, fighting inflation instead of trying to stimulate growth. But it does once again come down to central banks.
And they're probably less likely to step in unless there's real severe market stress.
Yeah.
Like we saw, and the Bank of England stepped in to kind of stabilize the rates market there for worries of the entire government bond market falling apart in earlier this fall. I mean, the other thing you mentioned that is just interesting point is just thinking about debt service cost. Is we've been living in a low interest rate world for the last decade, and you think about tightening from the standpoint of monetary policy tightening, but then you start talking about fiscal tightening. I think something like a third of treasury issuance is in T-bills. T-bill rates now are close to 4. So financing costs have gone up quite significantly for the U.S. government, and this is going to be true for the most developing world, which have to be somewhat of a headwind for any sort of fiscal stimulus we're likely to see.
Absolutely, and it will cause more scrutiny around the deficit, which is something we haven't thought about much at all. If you think about some of the spending that's happened over the last couple of years, that's a different kind of environment than we've been dealing with.
Yeah, and we wanted to talk a little bit about inflation. I think one of the things, part of that government spending side of things is more than half of government spending is indexed to inflation. You just think Social Security, for example, obviously indexed to inflation. And when we look at kind of what we're seeing in kind of inflation expectations over the next couple of months, and just things that have transpired this last fall, inflation in September for core CPI was a little under 0.6% month over month. Tomorrow on November 10th, we'll get the updated inflation results for October, but there's some good stats published by the Cleveland Fed that are very accurate in terms of predicting where inflation, or have been very accurate in predicting inflation. And they're looking at 0.5% growth month over month for core inflation for October, and forecasting something similar for November. So we're not exactly seeing the bend lower in terms of the path of inflation, which I know is something we've been concerned about for more than 9 months now. And it's clearly kind of have an effect on how we think about the markets, what kind of regime we're in, a lot of different issues that we're seeing out there.
It's something that we looked at this summer. Remember when inflation was coming in at 8.5, and we said it's going to take 7-8 months of zero prints for CPI to get back below 4%. That's headline. You're talking about core. A similar story there, where that's just unlikely to happen given the pressures that we have. So we may have hit peak inflation, but getting inflation down and then making sure that longer term inflation expectations come back to being anchored or stay anchored low. They haven't become unanchored, but I think that's something the Fed is wrestling with right now. And then balancing that against how much they've already done and the lag effect, the economic impact of the rate increases that they've already done. 4 percentage points of rate increases were on the order of what Volcker did back in the early 1980s.
Yeah, I mean, and we've talked a lot about what does that future path look like? You know, if we're running at 0.5% month over month inflation change, that's annualized over 6%. And if we need Fed funds to set some rate above inflation, and if inflation stuck at 6, that is a very ominous expectation for where Fed funds would be. Because right now, I think peak Fed funds is above 5% now, and that clearly is going to dictate to some degree, the market optimism or pessimism over the next 6 months in terms of where the Fed's likely to go.
Yeah. Do you think inflation is entrenched at this point?
It's something that we've talked a lot about internally. I think all of us are hesitant to say yes, but there's a certain point when the data is 0.5, 0.6, 0.7, 0.4, and you get these longer tenured aspects of inflation like shelter, some of the service components that we see in kind of the inflation data that says inflation is maybe more entrenched than we would like. And I think the big worry is if inflation expectations start to become grounded into the average consumer. So are we rushing to, go to the store to buy something because we're worried about price changes 2 or 3 months from now? And I think the biggest worry in my mind is, you see some of these consumer surveys that ask about, what folks view inflation to be over the next 3 years, 5 years. If you start seeing those tick up, then you're going to see a really aggressive Fed. And then we probably are talking more Volcker-like in terms of where interest rates are going to go.
Yeah, and that's got huge implications for the bond market when you think about where in longer term inflation pricing is still for the bond market. We're still, when you get out there beyond 5 years, still in the twos for inflation expectations.
Yeah, 10-year break evens are 2.5, which there's a big disconnect from the market. And I think the Fed certainly hopes that the 10-year break evens of 2.5 are the reality. I think a lot of consumers are maybe not feeling that today.
Yep. And the other side of this is that 4% in rate increases is an enormous move in the period of a calendar year. And the economy is just starting to feel that. And the economy will slow down because of that. It could slow down enough to create a recession, and a severe enough recession that inflation comes way down because of that. And that's the real unknown for the Fed right now is have they done enough? I think they probably feel like they haven't. I think their biggest worry is having stop and go monetary policy like the 1970s, right?
Yeah. And what do you look to as kind of the kind of best, canary in the coal mine is not maybe the best term, but just, the most relevant data point to say, okay, inflation seems to be slowing, the economy slowing down, start easing off some of these wage pressures and kind of, economic price pressures we're seeing.
I think you talked about wages. I think that's a big one. Starting to see wage growth turn over. Employment obviously is more of a coincident measure, but you still have 10 million job openings right now. So that's another thing that I think we need to continue to look at and that the Fed is continuing to look at. And that will be a possible challenge for them. I think they've raised rates 400 basis points. They've done all that with unemployment at a 3 handle.
Yeah.
Unemployment's 5 or higher. Are they still going to have the courage and conviction to raise rates if they need to? And that's a huge unknown, I think.
Yeah, and we, amidst the discussions we have internally with the investment team, we have a wide range of kind of diverse voices, and one of those colleague of ours that kind of questions the political independence of the Fed, and if we see 2.5, 3 million jobs lost as a result of the Fed tightening cycle, and we still don't see price pressures ease enough, that you start to wonder, are they willing to kind of do what it takes? And this goes back to the stop and go policies that we saw in the 1970s that really kind of created the really hyperinflation environment from that time.
Yeah, yeah. I don't know. I don't think anyone does.
Exactly. And let me ask maybe the $50,000 question, or it'll soon to be inflated away. So maybe it needs to be the $100,000 question.
Yeah.
Of do you think we included in kind of the investment community, we afraid to say the word stagflation?
Um, I think there is a lot of hesitancy to use that word, and I think the reason there's fear about it is because the one example we can turn to see stagflation in economic history and recent economic history is the 1970s.
Mm-hmm.
And so you say stagflation, and all of us by human nature think, oh my God, a whole decade of low growth and high inflation.
Yeah.
Stagflation as an environment isn't necessarily a full decade. It's a period of high inflation with low growth, high nominal growth, not much of that being real economic growth, more of it driven by inflation. I think it's hard to look at the backdrop we have today and not call it a stagflationary environment.
Yeah.
And I think everything you're seeing from the Fed should tell us, and other central banks, you're seeing the Bank of England, the ECB, Bank of Japan is behind still, but you're seeing these major central banks raise rates looking to fight inflation. They're worried about that stagflation spiral and don't want to create a decade-like environment. Where we end up on it, how long it lasts, I think that's a huge unknown, and it's based on what the policy path is, what the market and economic reaction is. But I would say we are in a stagflationary environment, and it's policy decisions that will drive how long we're in it.
Right. Yeah, and as you know, I've been, personally hesitant to use the word stagflation just because it carries such a big connotation.
Yeah.
And for a lot of folks, but when you look at some of the key kind of metrics just in terms of the yield curve, the 2-year treasuries trading 50 points below the 10-year treasury, that historically is a sign of some sort of stagflation type environment where you got this really deep tightening coming from central bank that's pushing short end of the curve up. You've got these growth concerns that are keeping the back end of the curve and the 10-year yields suppressed, which makes for a really difficult market environment, which I think most everyone would agree that certainly some level of turbulence is we've experienced year to date, but also maybe is a little bit more to come for a longer period than a lot of folks maybe are prepared for. And it's kind of feeds into, I think, some of the discussions that we've had, and we'll wrap up with this, is just thinking about, should we be developing, a bit of a playbook to think about how do we deal with, potentially this new regime or kind of temporary regime of stagflationary-like conditions?
Yeah, I think we need to. And I think it starts with just the recognition that we're in a regime change, or we've shifted to a new regime, and recognizing that that means a new set of tools need to be put into use for portfolios. It means probably more activity in portfolios. If we think about the last several years of this quantitative easing regime, you could just add equities and you'd be very successful doing that. And you were right to do it because the risk return trade-off was there. You had equities giving you a 7% 10-year expected return, and bonds only giving you 1 or 2. So you had to take more risk. You had to stretch out. Now being concentrated in equities, an asset class that probably gives you a positive return in an inflationary environment, but not maybe a positive real return. You've got to think twice about that and maybe take your risk posture down a little bit, especially at this point in a stagflationary environment where we haven't seen the recession yet. You've got to think about assets that are yielding more than inflation. So that's possibly nominal bonds, but credit bonds that are giving you more than you're getting from CPI. You've got to think about more diversifying asset classes, maybe adding more inflation exposure to portfolios. And then many investors have added to private markets over time and are building programs there. With that liquidity premium and top quartile managers providing excess returns, you should be outpacing inflation there. But you only get to do it if you stay committed and keep that vintage year diversification. So staying committed and building those programs is really important as well.
Yeah, it's really important. And I think, the other piece I'd add to that is just the behavioral mindset that we've all kind of adopted over the last 10 years, where we've gotten used to the Fed stepping in, we've gotten used to equity markets rebounding rapidly, and history says this type of environment is not one where we're going to see rapid reversals in central bank policy or rapid ticks up in equity markets. We're going to see more volatility, and I think it's reinforced in a lot of our thoughts on the markets. If folks have read some of our materials and seen our webinars of having a bias to short-term investment grade bonds, having a bias within U.S. equities to value, and also at the same time making sure we all have enough liquidity to kind of meet the needs to be able to run our portfolios. And some of that's to have disciplined pacing plans, and some of that to meet expenditure that are likely to happen for investors down the line.
The value equities are a great point. Having shorter duration cash flows can really help in this environment. The other final point that I would make is just from a behavioral perspective. I think you brought up some great points of how you need to shift your portfolio. All of those things lead us to something that maybe starts to get us looking a little different than peers. And I think over the last several years, all investors have had an increasing focus on peers because everyone was piling into equities and everyone was being rewarded for doing it. And I think we've all got to take a step back and reflect and say, am I willing to look different now? And I think those that are have a better chance of being successful in this upcoming challenging environment.
Yeah, that's a great point. And we'll end on that. And hopefully, I think we all hope it's not too challenging an environment, but I think we're certainly preparing ourselves for maybe a tough start to 2023. So with that, thank you, Tim, for joining us. For folks listening, hopefully you're still listening. And if you do have questions, feel free to reach out to your consultant at NEPC, and love to hear any feedback and thoughts you have on the markets, your portfolio, and things we should be thinking about for 2023. So thank you all.
Thanks, Phil. Take care.